Hello and welcome to this video. In this video, we are going to do a A-level question from paper 3, variant 31, May, June 2019, question 1, based on preparation of financial statements. The following information is given. The Director of K Limited has provided the following information at 31st December 2018. Land and building cost $400,000. Accumulated depreciation at 1st January 2018 $40,000. Plant and machinery cost $248,000. Accumulated depreciation at 1st January 2018 $121,600. Motor vehicle cost $153,000. Accumulated depreciation at 1st January 2018 $84,800. Trade receivable $126,000. Other receivable $12,500. Cash and cash equivalent $80,300. Debit and trade payable $108,000. Other payable, that is $13,200. Ordinary share of one each $500,000. Retain earning at 1st January 2018 as $94,300. Draft profit for the year as $152,000. The following items have not been taken into account. First, administrative expenses include a payment of $7,500 for insurance, which covers the period from 1st December 2018 to 31st May 2019. Second, the inventory at 31st December 2018 was valued at cost of $94,100. Furthermore, it is given that the trade receivable include $2,000 for a customer who has gone bankrupt. The directors are also of the opinion that a 3% provision for doubtful debts should be created. Land with the original cost of $150,000 was revalued as $240,000 on 31st December 2018. On 28th January 2018, a motor vehicle was purchased at cost of $25,000. An old motor vehicle was part exchanged for $13,000. This had a cost of $20,000 and had been depreciated by $9,760. The balance of purchase price was paid on 31st January 2019. Depreciation for the year ended 31st December 2018 has not been provided. Annual depreciation is to be charged on the following basis: land nil, building 25 years using the straight line method, plant and machinery 10% using the straight line method, motor vehicle 20% using the reducing balance method. A full year's depreciation is charged in the year of purchase, but no depreciation is charged in the year of disposal. In the A bit of the question, we are asked to identify the accounting concept which is applied with respect to item 1. The item 1 which we have here is the administrative expenses, which includes the payment of $7,500 for insurance, which covers the period for 1st December 2018 to 31st May 2019. The concept which we are going to apply here will be the matching or the equivalent concept, which states that the expenses for a given period should match the revenue of the given period. So when we are making the income statement for 31st December 2018, we are going to include the insurance just for 1st December 2018 till 31st December 2018, that is for 1 month, and the rest of the insurance, which is from 1st January till 31st May 2019, will be treated as the prepaid expenses and will be a part of the statement of the financial position, where we are going to add this to the other receivable. Item 2, here the information for item 2 given is the inventory at 31st December 2018 was valued at cost of $94,100. So this is a closing inventory which we have valued at cost. The closing inventory, we usually value it on cost based on the prudence concept. We don't value it on the basis of selling price or the market price, because the prudent concept states that profits should be recorded only when they are earned. Hence, as we have not earned any profit on the closing inventory, we value it at the cost price. In the B bit of the question, we are asked to prepare a statement showing the revised profit for the year ended 31st December 2018. So, for making this statement for revised profit, we are going to do all the calculations which is given in the adjustments and which was not taken into consideration when the draft profit was calculated. First, let's do the working and then we'll make the statement. We'll begin with the first thing, which is given that administrative expenses include a payment of $7,500 for insurance, which covers the period for 1st December 2018 to 31st May 2019. So, when they have made the draft profit, what they did is they have included the insurance expenses, which is from 1st December till 31st May 2019. And as I have stated earlier, based on the matching concept, only the insurance which belong to the period of 1st December 2018 till 31st December 2018 should be considered as the expenses for the given period. However, here the expenses was overstated. So let's first calculate the insurance for 1 month period. For 6 months period, the insurance given is $7,500. For 1 month, how much? So for 1 month, when we cross multiply it, that is, we take 7,500 times 1 by 6, we get the insurance as $1,250. This should have been the expenses which occurred during the period of 31st December 2018, and it was not considered as this amount. Instead of that, the amount of insurance which was considered as an expense was $7,500. So we are going to take $7,500 from this. We subtract the expenses which belongs to this period, that is $1,250. We get the amount as $6,250, which is the prepaid insurance, and this was considered also as the expense, and because of this the expenses were overstated. So to rectify this, we will add this amount back to the draft profit. Then next we have trade receivable, which includes 2,000 for a customer who has gone bankrupt. This is a bad debt or irrecoverable debt, and this is an expense which has not been considered. Hence we are going to subtract this 2,000 when we make the revised profit. Then furthermore, it is given the directors are also of opinion that a 3% provision for doubtful debts should be created. So first let's calculate the provision for doubtful debt. That is, we'll take the debtors value, which is given as $126,000. From this we are going to subtract the irrecoverable debt, that is 2,000. Then after that we'll find the 3% of the value, which will be $3,720. For provision for doubtful debts, what we do is we take the increase for the provision and enter it as the expense in the income statement. Here, as we are making the provision for doubtful debts for the first time, hence the total amount will be considered as an expense, and hence the whole amount will be subtracted from the drafted profit when we make the revised profit. Then third, we have depreciation for the year ended 31st December 2018, and which has not been provided. So now we are going to calculate the depreciations and we are going to subtract it as an expense and provide it in our revised profit. So let's begin with the first thing. Land, it's nil because land was appreciated. Then buildings we have 25 years using the straight line method of depreciation. It was given that the land value which was included in land and building was $150,000. Therefore, we are going to take the total value of land and building, which is $400,000, and from there we are going to subtract the value of land so that we can get the value of the buildings. So once we subtracted, the value just for building is $250,000, and for this we are going to find the depreciation on straight line method basis and for 25 years. So $250,000 divided by 25 years, that is the useful life, we get the depreciation for building as $10,000, and this will be subtracted from the profit. Furthermore, let's calculate the depreciation for plant and machinery. It is given that the plant and machinery is depreciated by 10% using straight line method of depreciation. So we are going to take the cost of plant and machinery, which is $248,000. With this we are going to multiply 10%, which is the rate of depreciation. We get the value for depreciation for plant and machinery as $24,800. As this is an expense, it needs to be subtracted to find the revised net profit. Then we are going to depreciate the motor vehicles. It is given that motor vehicles are depreciated by 20% using reducing balance method. For reducing balance method, we need to calculate the net book value of motor vehicle, which is calculated by taking the total cost value of motor vehicle and subtracting the total accumulated depreciation. Here it is given the total cost value which was given in the information as $153,000. However, in the additional information, it was stated that additional purchase of motor vehicle which was done on 28 December 2018 have not been considered. As we have purchased this new motor vehicle, we are going to add this value. However, it was also stated that there was a part exchange. By giving up a old motor vehicle, we have purchased the new motor vehicle, and the old motor vehicle which was sold will have a value of 20,000. As this was sold, we are going to subtract it. We get the total cost value for motor vehicle as $158,000, and the total accumulated depreciation which was given in the question was $84,800. However, again this was not considered, that is a part of old vehicle was sold, and as the old vehicle was sold, the depreciation for this old vehicle has to be subtracted to find the total accumulated depreciation. Hence we get the total accumulated depreciation as $75,040. Now as we have both the values, that is the total cost value of motor vehicles and total accumulated depreciation, we are going to take the cost value, and from there we are going to subtract the accumulated depreciation to get the net book value. And here we got the net book value as $82,960. Now as we have the net book value, we are going to multiply it with 20%, which is the rate of depreciation, and we get the depreciation for motor vehicle as $16,592. As this is an expense, hence it needs to be subtracted. Then there was a gain on the disposal of motor vehicle when a motor vehicle was given up as a part exchange. Hence we are going to calculate that as well. So here the cost of motor vehicle which was given as part exchange was $20,000, and it has accumulated depreciation as $9,760. So the net book value of this motor vehicle was $10,240. However, when we have given it or sold it in the form of part exchange, we got a value of $13,000. So from $13,000, we are going to subtract the net book value, that is $10,240, and this will be the gain on the disposal of motor vehicle, which is $2,760. As this is a gain, it is added back to find the revised net profit. Now let's make the statement showing the revised profit for the year ending 31st December 2018. We'll start from the draft profit for the year as $152,000. To this we are going to add the prepaid insurance which was done in the first working notes. We are going to subtract the irrecoverable debts, provision for doubtful debts which was calculated in the second working notes. We are going to subtract the depreciation on building, depreciation on plant and machinery, depreciation on motor vehicles. All this were calculated in the third working notes. We are going to add the gain on the disposal of motor vehicles which was again calculated in the third working notes. We get the revised profit for the year as $103,898. In the C bit of the question, we are asked to find the net book value of motor vehicles at 31st December 2018. We are going to do it in the same way as we have done in the third working notes. We will find the total cost value of motor vehicles and we subtract the accumulated depreciation. Here the only difference is that we are going to also consider the depreciation provided for the year from 1st December till 31st December 2018 to find the accumulated depreciation. So let's begin with the cost value of motor vehicle. On 1st January 2018, the cost value of motor vehicle was $153,000. To this, we are going to add the motor vehicle which was purchased on 28 December 2018, and we are going to subtract the motor vehicle which was disposed as a part exchange as $20,000, and we get the total cost value of motor vehicle on 31st December 2018 as $158,000, and the accumulated depreciation was given on 1st January 2018 as $84,800. From this we are going to subtract the accumulated depreciation of the motor vehicle which has been disposed, that is $9,760, and we are going to add the depreciation for the year, which was calculated in the third working notes as $16,592. So we get the total accumulated depreciation as $91,632. Now the net book value on 31st December 2018 will be the total cost value of motor vehicle, which is $158,000 minus the accumulated depreciation, which is $91,632. We get the net book value of motor vehicles on 31st December 2018 as $66,368. In the debate of the question, we are asked to make the statement of the financial position at 31st December 2018. We are going to start with the working notes. We are going to start from the non-current assets, and the first one which we are going to calculate is for land and building. The land and building at cost which was given was $400,000, and it was also stated that the value of land have been appreciated after evaluation. So we are going to add that after evaluation, the value of land was $240,000, and before evaluation, it was $150,000. So the appreciation of land after evaluation was $90,000, which will be added. Then we are going to subtract the accumulated depreciation on building, which was given as $40,000, and the depreciation for the year is $10,000, and hence we get the net book value for land and building, which will be mentioned in the financial statement of financial position as $440,000. Then we have plant and machinery. Plant and machinery at cost was $248,000, and the accumulated depreciation which was given was $121,600. Then we have the depreciation for the year as $24,800. So the net book value of plant and machinery, which will be mentioned in the statement of financial position, will be $101,600. Then we have one more non-current assets, which is the motor vehicle, and as we have done the calculation already in the statement, we are not going to do it again. Then we have the current assets. We have the current assets starting from the trade receivable and other receivable. In the trade receivable, it was given the value was $126,000, and we are going to subtract the irrecoverable debt, which is $2,000, and the provision for doubtful debts, which is $3,720. We get the trade receivable as $120,280. The other receivable which was given was $12,500. To this, we are going to add the prepaid insurance, which was calculated previously as $6,250. So we get the total other receivable as $18,750. Therefore, the trade receivable and other receivable will be $120,280 plus $18,750, which will be $139,030. Now let's calculate the retained earning. The retained earning at 1st January 2018 was given as $94,300. The revised profit for the year, which was calculated in the B bit, was $103,898. We get the retained earning as $198,198. Then we'll calculate the trade and the other payables. The trade payables was given as $108,000. The other payables was given as $13,200. To this, we are going to add the balance of the purchase price of the motor vehicle, which was paid on 31st January 2019. And how do we calculate this? We are going to take the purchasing price of the motor vehicle which we have purchased, that is 25,000, and from here we are going to subtract the motor vehicle which was given as part exchange and have a value of $13,000. So we get the balance which have to be paid for the purchase of motor vehicle as $12,000. So once we add all this, we get the trade and other payable as $133,200. Now let's make the statement of the financial position at 31st December 2018 using the calculations which we have done before. We'll start with the non-current assets, in which we have land and building, which was calculated in the first working notes. We have plant and machinery, which was calculated in the second working notes. We have motor vehicle, which was calculated in the C bit of the question. Once we total all the non-current assets, we get the total non-current asset as $607,968. Then we have the current assets, in which we have inventory, which was given as $94,100, trade and other receivable, which was calculated in the third working notes, cash and cash equivalents, which was given as $80,300. Once we total this up, we get $313,430. And once we add the non-current assets and the current asset, we get the total asset as $921,398. Then we have the equity and liability, in which we have the capital and reserves. In this we have ordinary share of $1 each, which was given as $500,000. Then we have revaluation reserve, which is $90,000. Then we have retained earning, which was calculated in the fourth working notes, and we get the total capital and reserve as $788,198. Then we have current liabilities, in which we have trade and other payable, which was calculated in the fifth working notes. Once we add this two, we get the total equity and liability as $921,398, as both the total assets and the total equity and liability tallies. Hence, the statement of financial position is completed. With this, we have completed this question. Thanks for watching my videos and have a great life.